So let's try and recreate the income statement just so that you know how to do it, even though I've explained it. So we start with sales. We have cost of goods sold. We have other expenses. Let me start placing in data. So I start with 6034000, and this is for the year 2015. And let me just mark this with a dollar sign so that you know we're trying to create as in the PowerPoint. Cost of goods sold, again, like I had mentioned, this is corresponding expense that has gone into producing the products that have been sold. Again, it has to be a matching principle, so this is going to be 5,528,000. Then other expenses, which are overheads, like advertising, transportation, which are again taken as cumulative for those sales numbers. So the total operating cost, excluding depreciation and amortization, is going to be the sum of this plus this, and this is total operating cost, and that is excluding depreciation and amortization. So I'm just abbreviating for brevity of the space. Now we come to depreciation and amortization, and remember, this is an expense, or is taken as an expense, but company does not pay this to any party. So this is 116,960, and you can see that obviously this has increased substantially compared to 2014. Why? Because the total fixed assets have increased substantially, so depreciation figure is also going to increase. So the first major milestone in the income statement is EBIT, which is earnings before interest and taxes, and this is going to be equal to the 6,034,000 sales figure minus the depreciation and amortization and the total operating expense. So taking this plus this, so that is going to be a negative 130,948. That means you already know that this is going to be a loss for 2015. Then we have the interest expense. This is the expense that the company has to pay out for the bonds that they have taken out. So this is the interest expense for those loan payments, 136,012, and the earnings before taxes is going to be 130,948 minus 136,012, which is going to be negative 266,960. Now taxes are the corporate taxes, and this is, as you can see, a negative number. That means it's charged back. That is, the company is not paying taxes. On the other hand, it's charging back because it's a loss, and we'll discuss about that in slides to follow. This is going to be a percentage of your total earnings before taxes, which I believe should be 40%. Let me see. Yeah, it's 40%, 106,784. So that's a negative number again. So income, net income is going to be the 266,960, and since this is taxes which are charged back, so basically you're not paying out, in fact you're receiving this funds in, so that's your number, 160,176. Now that is how you will create an income statement. So I created that for 2015. We've already discussed compared to 2014 how these numbers fare or are in 2015. Now let's move on. So some of the additional data that's given to us are number of shares. The company, as we had discussed, decided not to raise additional funds through stocks. It rather has used bonds to raise capital for expansion projects. That's why you see that the number of shares have not increased between 14 and 15. They're the same 100,000. Earnings per share is gone from 88 cents per share down to negative 1.602. And just to show you how you can calculate that, so all you do is take your net income to calculate earnings per share, divide the net income by total number of shares outstanding, which in this case is 100,000. There you go. So that's negative 1.6, and if you wanted to make it precise, just increase the number of decimal points on Excel. It's going to give you the same number. Just to show you in comparison for 2014, if we go back, the net income here was 87,000, and you can calculate that for practice, but just to show you, we arrive at this figure at 87,960, which was positive. Absolutely the reason why the shareholders are not happy, the board is not happy, because in 2014 you had an excellent positive net income, and now in 2015 you have a negative income. That means it's a loss. So just to show you, for 2014 earnings per share is going to be again that number divided by 100,000, and that's 88 cents, as we have seen in the slide here. There you go. Dividend per share is the share that the company decides to share with its shareholders, from the profit. But obviously from 15, since it did not make any profit or didn't have any net income, this money is going to come from the cash in hand from the previous year, or the one that it was holding, because it did not make any net income. Stock price, obviously because of the financial performance, has dropped from $8.50 to 2.25. And then lease payments are the payments that the company has to make annually for rental space and so forth, which is $40,000, and that has not increased. So now we come to the statement of stockholders' equity, and this again shows you the equity, shareholder equity, that is the worth of shareholders in the company, per se. So it is represented by the shares, which are 100,000, and the amount is $460,000. Now that can be looked in, from the balance sheet, there you go. So the common stock here is listed at 460,000, and this is the amount that's referred to in the amount section. So that you get from the balance sheet. This is the one here. So we can keep that 460,000. Retained earnings is again the figure that you can collect from your balance sheet. On the equity side, so this is the retained earning figure, 203,768. And then we have to deduct the losses. Obviously, you made some losses in 2015, so that you can look again from your income statement. And this is the 160,176. So that loss would have to be covered from the retained earnings. Plus, you also decided to share dividends with shareholders, which was in the figure of 11 cents per share. So 11 cents 0.11 multiplied with 100,000 is $11,000. So just to put that in context, there you go, 11,000. So coming back, there you go. The total stockholder equity in 2014 was 663,768. That is the combination of the common stock amount plus retained earnings, because that belongs to the shareholders. Now this was in 2014. Now remember, after the loss and the dividend that's been paid out, 2015, so the balance is going to be the same for shares. Nothing has changed. Stock amount has not changed because you did not sell or add any more stocks. The cash in hand figure obviously has changed because you have to take care of the losses and the dividend that's been paid out. So let's deduct that amount. Okay, I can just put a plus here. All right, there you go, 32,592. Obviously, that's not good because your cash in hand or the retained earning is now gone substantially down. So this is going to now reflect in the overall balance. So there you go, 492,592. That's the total stockholders equity. So obviously compare that to 14 and now to 15. Stockholders are not going to be happy because their net worth has eroded within a matter of a year. So now we look at the statement of cash flow, and this is pretty much how we had discussed. This starts with net income. And this is, we're talking about 2015, so you start with a negative net income of 160,176. So this is going to be in 3 parts. So let me just show you each part. So this is operating activities. So we start with net income, that is negative 160,176, and that's coming from the income statement. Depreciation and amortization, again coming from the income statement, that's an expense, 116,960. And then you have increase in accounts payable. So you go back to the balance sheet and go to the liability side, and you can see that accounts payable has increased from 145,600 to 524,160. So you can simply take that amount, 524,160 minus 145,600. So that is that should be the amount. There you go, increase in accounts payable. That's how you can calculate. And then increase in accrual, same way, you just go back, take the difference between the two, and you should get the same number. I'll leave it for you to calculate. So this is in accrual. Then you have increase in accounts receivable. Now this is going to be a negative number. Why? Because accounts receivable is going, if accounts receivable are going to go up, then your net cash situation is going to go down, because this is the money that your clients have to pay you, which they haven't paid. And if that amount increases, your overall cash situation is going to drop down. So again, this you can get from balance sheet on the asset side. There you go, accounts receivable. So you take that as 351,200 minus 632,160. I took the reverse because this is to be treated the other way around, because a higher accounts receivable means lower cash for the company. A higher accounts payable means more cash with the company, because now you got more time to settle your bills. So let's go back. And then increase in inventory, again, the same logic applies. The higher inventory, the more cash that's blocked, and that's why that's a negative number. So again, you can take 2014 and minus 2015 number from it, and you'll get this number, 572. Let me put a negative sign, 572,160. And just add all of them, and there you go. So from part A, you have negative 164,176. Then we come to the other two parts, and the second part is the long-term investing activity, and this is addition to property, plant, and equipment. Again, the logic applies. If you add property, plant, and equipment from 14 to 15, money is going to go out. So obviously we did that, and that's why you see this negative number. This is going to be negative 711,950. And where you can get that information, again, from the balance sheet on the asset side. So if you go back, there you go. You got net fixed asset, and you can do 344,800 minus so let me see, 491,000 minus 1202,950. There you go. That's your gross fixed asset number. So this is going to be negative 711,950. So this is the logic that you have to apply when calculating your statement of cash flows. So this is the second component. The third component is going to be financing activities. So you have increase in notes payable So this is the short-term loan that the company has taken. And remember, when you have more loan taken, that's going to mean more money coming in. That's why you have a positive number, 436,808. And then you have long-term debt. Again, money would come in. If the long-term debt would have been retired, then the money would have gone out. Payment of cash dividends, obviously this is money going out. So the total in this case is going to be 825,808. There you go. So the net decrease in cash is going to be you add all three and you get the increase or decrease. Since it's negative, this is going to be the net decrease in cash. Cash at the beginning of the year is 57,600, and that is implying that you have a net ending cash balance of 7,282. Obviously that's not good. So this is a situation why the shareholders are not happy. So I guess now you know how to calculate, these components and aspects. So conclusion from De Leon's financial condition from its statements of cash flow. Net cash from operations is negative 164,176, mainly because of negative net income. The firm borrowed heavily, in the amount of 836,808. That means the short-term and long-term loans to meet its cash requirements. Even after the borrowing, the cash fell account by 50,318 that we calculated. That allowed us only with a net cash balance of 7,282. So did the expansion create additional income, after tax operating income? And that we can calculate by this formula, which is EBIT, earnings before interest and taxes, coming from the income statement, multiplied by 1 minus tax rate. In this case, we are going to assume the corporate tax rate of 40%. So in case of 2015, EBIT was negative 139,408 multiplied with 1 minus the 40%, so 0.40 or just 0.4, and that is negative 78,569. Same way you can calculate for 14, and the number is 114,257, and so the answer is it did not create operating income, additional operating income, after tax operating income compared to 14, the expansion. And like I said, there is no clear-cut answer. Yes, you might see on the paper that it did not help, but like I said, certain businesses will take some years to recover from expansion, especially the social media businesses where the main emphasis is to grow the customer base. So for the first couple of years, in fact for 5 or 6 years, companies are spending a lot of money just to expand and increase the customer base. Companies like Twitter, companies like Google, companies like Facebook were running into losses for the first several years before they even started seeing any sign of profits. Now looking at the net operating working capital, which is equal to current assets minus current liabilities minus notes payable, and that simply can be taken from your balance sheet. So current assets for 15, and we can, let me show you where to get it from. There you go, you have your total current assets. That is where you can get your information. And then you have what else is required. Current liabilities is again going to come from the balance sheet, but on the liability side, and notes payable again on the liability side. So there you go. That's income statement. There you go. So notes payable is 200,000 for 14, 636, 800 for 15. This is the total current liability number, 1,650,568 for 15 and 481,600 for 14. So this is where you will get the numbers. And you know, the more you practice, the more you realize where to get those numbers from. So in this case, you know, I showed you where to get the numbers from, and simply by following this formula, which is going to be current assets minus current liabilities minus notes payable, and the breakup of current assets, you know, you could have taken the simple one number, or you can take, you know, the breakup. So for example, current asset is comprised of cash, accounts receivable, and inventory. You can take 3, or you can take the total current, you know, asset number, and that would work as well. So here, for example, they've taken the 3 numbers. Okay, so it doesn't really make a difference. So we can see that net operating working capital for 15 is 913,052, and for 14 is 842,400. Now, net operating working capital is largely the difference between current assets and current liabilities minus the notes payable. So basically it gives you some indication of how much of quick liquid funds are at your disposal for expense or any need purposes. Now it does look nice for 15, but remember, you've locked in a lot of your funds in inventory, which will not realize too fast into cash. So that way you have to be careful to interpret those numbers. So assessment of expansion's effect on operations sales has definitely gone up from 14 to 15. After tax operating income has gone into a loss. Net operating working capital does look nice on paper, but like I said, view it with caution, because you have a large portion of that amount locked into your inventory, which still hasn't sold. And then net income is obviously, as you can see, is into a loss. So how would I interpret this? Well, obviously on paper it doesn't look good, but then you have to realize in today's world where of the competition and the kind of sector the companies are in, sometimes you do have to wait for a couple of years before the expansion projects can really come out with good results. But then in certain instances it may not work at all. Companies may spend heavily into launching a product that might not work at all. For example, Research in Motion, the manufacturers of BlackBerry, which were really a successful company once upon a time, but they fell behind because they could not keep up with the kind of smartphones that were coming in the market. And even after they tried to come up with new versions of their phone, they could not succeed because they had lost the battle among the likes of Samsung and Apple and LG and so forth. So what was free cash flow for 2015? And we can calculate that by taking earnings before interest and taxes multiplied by 1 minus tax rate plus depreciation and amortization minus capital expenditures plus the change in net operating working capital. Now, change in net operating working capital you can get from here. So between 15 and 14, so the difference is that change. So this number is that change number, and I can show you. So we can take that. This is going to be 913,042 minus 842,400. There you go, that's the number here, the 7642. This is the number that we just calculated. And then the rest of the numbers, you can easily get from the balance sheet. So capital expenditure, for example, will come from the fixed asset. So this one here, gross fixed asset 1,202,950. That's for 1,202,950 minus 491,000. That's the difference between the 2 years. That's how you will calculate. Okay, so just go back and get the numbers and plug them in, and you will get those results. So this is what we did, for the capital expenditure. And then you take EBIT coming from the income statement, which we just had done previously, 1 minus 40% tax rate, plus depreciation, amortization again will come from the income statement. So you get free cash flow of 15, that's negative. So this is a negative free cash flow. Is it always a bad sign? And you can say yes and no, like I said, based on what the sectors are. But for the purposes of the exam, purposes of starting out just on the book, it's always safe to say yes, it was bad. But then in interview, you can also defend your answer by stating some examples of the likes of Facebook, Google, because these companies which are immensely successful today were struggling like the results that we have just seen. So if you were to, let's say, cut the cord per se, let's say if you're a manager and say, well, in the first year we made a loss, let's just abandon this project, then we wouldn't have ever had companies like Dell or Apple or Facebook or Twitter and so forth. So looking at the performance measures for evaluating managers, accounting statement is insufficient for evaluating managers' performance because they do not reflect market values. So market value added is a difference between market value and book value for firm's equity. And the way you calculate is by taking price per share multiplied by number of shares minus the book value. The book value will come from the shareholder equity on the balance sheet. Economic value added is really, in simple logic, the cost of capital. For example, if you're taking loan at 3% and you've turned around and made a profit which has resulted in a return of 5%, then the 2% added is the economic value added. So is the estimate of business true economic profit for a given year. That's why you have the EBIT multiplied by 1 minus the tax rate minus total invested capital multiplied by the cost of capital. That cost of capital is going to be the interest rate. We'll talk about that concept of weighted average cost of capital, but you can simply think of it as interest rate that you paid for the loan, because in this case the company has simply taken a loan. So let's take the example of market value added. And this is coming from that additional information. We have the case of 2.25, that's the share price in 2015, multiplied with 100,000 shares. And this is minus 492,592. That's on the book, the value on the book, which is negative 267,592. And then in 14, the share price was $8.50 multiplied with 100,000, and that minus 663,768 again on the book is 186,232. So you can see that market value has tremendously depreciated. And let me show you where we're getting these numbers from. You can also look here. This is the number, balance 492,592, and 663,768. This is the total shareholders equity, but you can also, look at the balance sheet, and this is the shareholder equity. So total equity is 492,592, 663,768. So either way, wherever you want to get that data, you can get this. This is the figure I'm referring to. You can get it, from any of those prior statements that we calculated. So if EVA is positive, that is economic value added is positive, then after-tax operating income is greater than the cost of capital needed to produce that income. So like I mentioned, let's say I take a loan and the loan costs to me at 2%. I invest that loan in opening, let's say, a coffee cafe, and I make a return of 10%. So taking a loan at 2%, return at 10%, I've had an economic value addition of 8%, which is good for society because I've turned around and I've added economic value. That's why the term economic value added. Positive EVA on annual basis helps to ensure MVA is positive because it keeps on adding to the market value of the firm. MVA is applicable to the entire firm, whereas EVA can be calculated on divisional basis. So you can break it up. Let's say if I have a chain of restaurants, I can break it up into different, restaurants to see which one is really adding a higher economic value. And sometimes companies make that decision to shut down brands. For example, GM, when they shut down Hummer or the Pontiac brand, they must have looked at the market value added, that is, which brands were really providing much addition to the market value compared to the other ones. Does DeLeon pay its suppliers on time? Probably not, because accounts payable has increased by 260% over past year, while the sales increased by only 76%. If this continues, suppliers may cut off DeLeon's trade credit. Pretty much like a person. If I don't keep up with my bill payments, banks or my creditors may not pay me or may not extend more credit, in future. Does it appears that DeLeon sales price exceeds its cost price per unit sold? No, the negative after-tax operating income and decline in cash position shows that DeLeon is spending more on its operation than it's taking in. And again, maybe because it's a new business. What if DeLeon sales manager decided to offer 60-day credit terms to customers rather than 30-day credit terms? Now, that can be good or bad. If the competitors match the terms, sales remain constant. That is, if everybody in the market also starts extending 60 days, then this is going to create a status quo. So in that case, our accounts receivable would increase, cash would decrease. But what if competitors do not match and sales double? Now, that is actually good because our sales number would increase because customers would shift to our business, because now we're giving them more time to pay. And in long run, it might actually also kill the competition altogether, because as more customers come to me, now other competitors will be without customers and soon they will be out of business. So in long run, that is taking full control of the market. In short run, yes, I would have to bear some difficult time, because now I'm extended my credit terms from 30 to 60 days. So I might have to find some additional source of funding for those additional 30 days credit that I'm providing to my clients. But in long run, it might actually be beneficial because it'll kill the competition. How did DeLeon finance its expansion? We have already talked about it, not by stocks but by debt. So DeLeon finances expansion by external capital, that's debt. DeLeon issued long-term debt, which reduced its financial strength and flexibility. Would DeLeon have required external capital if they had broken even in 2015, that is net income equal to zero? yes, the company would still have to finance its increase in assets because they're expanding. Looking to statement of cash flow, we see that the firm made an investment of $11,950 in net fixed assets. Therefore, they would have to get that additional source of funds for capital expansion. So the raising of funds was important. Now they decided not to go through adding more stocks, but kept the debt as a source of funds. What happens if De Leon depreciates fixed assets over 7 years as opposed to current 10 years? So depreciation, if it's taken on 10 years, you're depreciating, on straight line 10% every year. So you're taking back 10% every year for replacement cost. If you do it over 7 years, obviously you're depreciating at much higher rate. So your inflow of cash is going to go up. But the machine is still going to live its own normal life. So there'll be no effect on physical asset. Fixed asset on balance sheet would decline because you're depreciating at a much faster rate, at 7%. Net income would decline because remember, depreciation is an expense. So it'll be taken as an expense. So that amount would be deducted from net income. Tax payments would decline because since your expenses are increasing, your net income would reduce and you pay tax on your net income. So taxes would reduce. Cash position would improve because the chargeback that you're taking, this money is going to come back to you. Now, ideally, you should keep that money aside for replacement cost of the machine, but in short run, sometimes, you can use those funds for some other uses. Let's briefly talk about individual taxes and corporate tax. And again, these are a frequent changing term. So generally, the specifics of individual taxes, they keep changing depending on, like recently, there were some changes made to individual tax rate and corporate tax rate. So these keep changing from time to time. So both have a progressive structure. The higher the income, the higher the marginal tax you pay. Now, marginal tax is the tax that you pay on the additional dollar that you earn. So it's not an average tax. There's a difference between average. Average is the total income corresponding to the tax you pay. That'll give you the average tax rate. Marginal is for every extra dollar that you earn, what is the proportionate tax that you're paying. So rates for corporations begin at 15% and rise to 35% for corporations with income over 10 million. Although corporations with income between 15 million and 18.33 million pay a marginal tax rate of 38%. They're also subject to a state tax which is about 5%. Individuals rates begin at 10% and rise to 39.6% for single individuals with income over 406,750 and married couple filing jointly with incomes over 457,600 may be subject to state tax. Some states don't have personal income tax. For example, I know for sure Florida does not have a personal income tax, and Florida also does not. Texas, also does not have personal income tax. These two states, I'm for sure that they do not have personal income tax. Interest paid, tax deductible for corporations, that is paid out of pre-tax income, but usually not for individuals. So when the interest is paid out by corporations on loans that they have taken, they can treat that as an expense. But individuals can't do that, for personal loans, student loans, or not students, but personal loans, credit card loans, mortgage, home loans, car loans. Mortgage loan interest rate is deductible. So the interest on home loans being the exception. Though there's a talk that, this should be taken away, but this thing again is so political that it might just keep going. And the reason that interest rate on mortgage loans is exempt is to, entice customers to buy home. Because real estate sector is so much integral to the growth of the economy, and this has helped spur home ownership in the U.S. Interest earned usually fully taxable, an exception being interest from munis. Munis are municipal bonds. So, for example, if I earn interest on a bank savings account, even though they pay very little, it's taxable. It adds to my personal income. But if I invest in municipal bonds, any interest that I earn from municipal bonds is exempt from federal tax. Though you still have to pay state tax, or maybe there's some other taxes on county or state level. Dividend paid out, these are paid out after tax income. Dividends received, most investors would pay 15% tax on dividend. So that's why it's sometimes called as double taxation, because the firm has already paid tax on its earnings, and then the net income basically is used to share dividends with shareholders, and then the shareholders would pay tax, personal income tax, on the amount that they receive from firm in the form of dividend. So investors in 10 to 15% tax bracket pay 0% on qualified dividends. Taxpayers in the 39.6 tax bracket pay 20% tax on dividends. Dividends are paid out of net income which has already been taxed at the corporate level. That's why it's sometimes referred to as double taxation. A portion of dividends received by corporations is tax excludable in order to avoid triple taxation. So what happens is sometimes firms themselves will invest in other firms. For example, Intel might invest in Microsoft, or Microsoft might invest in Intel. And the reason they do it is because they want to support each other, yes, but they also want to try and get a little bit higher return for cash in hand. These companies like Microsoft, Intel, Facebook, Apple, they got hundreds of billions of dollars in cash in hand. So if they were to put that money in a bank account, they won't earn any interest. It will be just money lying in a bank account. Whereas if they were to invest a certain portion in their business that they're interested in, or they would like to steer the operations of that business in a certain way, so they can buy a certain portion of shareholding of the business, and thereby they get a seat on the board to have a say. But other than that, they also get some form of capital gains or dividend that's earning for the business. So if they were to invest, let's say Microsoft were to invest in Apple, and Apple would pay out dividend, even though Apple does not pay much of dividend. But let's assume Apple does pay dividend. So Apple has already paid tax and now shares it with Microsoft, the dividend. So this is coming as taxed. Now Microsoft on its income is going to pay tax, so that's double taxation. And then when Microsoft shares its earnings with its shareholders, and the shareholders would have to pay tax on their income, so it'll be triple taxation. So to avoid that, a certain portion of dividends received by corporation, that Microsoft, for example, in this case, would be tax exempt. More tax issues, tax loss carry back and carry forward, like we had the example today where we had negative net income and that allowed us to get cash back. So tax loss carry back and carry forwards in corporate income can fluctuate widely. The tax code allows for firms to carry losses back to offset profits in previous years, or forward to offset profits in the future. Capital gains, defined as the profits from sale of assets not normally transacted in normal course of business. Capital gains for individuals are generally taxed as ordinary income if held for a year or less, and capital gain rate if held for more than a year. So business gains for individuals are generally taxed as ordinary income, if it's held for less than a year. But if it's more than a year, it'll be capital gain, which has a different tax rate. Most taxpayers would pay 15% taxes on long-term capital gain. So on short term, you obviously are paying a higher rate, if you come into a higher bracket. But if you keep a property for, let's say, more than 1 year, then you are paying only the capital gain tax, which is 15%. If you were to sell the property and make money, then you pay only 15%. If you sell the property and make money within 1 year, then you're paying at a much higher rate. So taxpayers in 39.6% tax bracket pay 20% tax on long-term capital gains. So that pretty much is the end of discussion on this chapter. Thank you for listening.